Good morning, welcome from the SuperReturn Emerging Markets 2015. I have with me Charlie Robertson, Chief Economist from Renaissance Capital, and myself, Muhannad Qubbaj, Managing Director, Private Equity at Gulf Capital. Welcome.
Thank you.
Thank you so much for your presentation this morning. It was very interesting, a very good start to the day. A lot of interesting opinions about what's happening in the region, and I want to recapitalize on just a few aspects of what you mentioned this morning in your presentation, which is what risks lurk in the investment industry and the financial industry over the next, let's say, 5 to 10 years. Number one, Greece and Europe's periphery voting for Venezuela, Argentina style policies. Number two, the possibility of a Chinese crash. Number three, excessive emerging markets borrowing. Number four, miscalculation by the Fed. And number five, shocks from global pandemics, which is a very interesting point. A couple of points that we haven't spoken about in detail, or you haven't spoken about in detail in your presentation, was the effect of the volatility in oil price, who the winners and the losers will be and why. You touched upon the fact that you have certain countries and certain emerging markets that will benefit from lower oil prices. And the second point is, if you look at the geopolitical risks on a global basis, if you can just highlight your thoughts and let us know if you think there's any interlinkage between geopolitical problems that have been happening. And a follow-up question to that will be how we can solve those geopolitical issues. All right, I know that's a lot of questions, but I'll repeat them to you as you see fit. We need to, in terms of geopolitics and problems, do we come in and solve from a military standpoint or economically?
So to start with the risks,
Yes.
it's probably 6 years out of 8. I'm bullish. 2 years, I tend to be more concerned that there's always cycles, and that at the end of the cycle, markets go down.
All right.
That private equity groups ought to be selling into the upswing during those 6 years, and then buying up the opportunities that arise when prices drop in those more negative 2 years. Arguably, it's probably more like 7 years of bullishness for every 2 years of negativity. So perhaps I'm slightly too bearish, but nonetheless, I'm now getting concerned we're at the end of the cycle.
But it's not imminent global doom in general.
What I'm concerned about is the markets having a double dip, such as we saw in 1937 after the 1929 Great Depression, such as we saw in 1980-82 after the 1973 crash, and such as we saw in the 19th century after some of their bigger crashes as well. And that's telling us we've already had one of the longest periods of expansion in US growth ever, one of the most successful reductions of unemployment ever, and we are at the point now where normally we'd be saying this is the end of the cycle. And in that, we would expect market valuations to start to change significantly. So prices would come down a lot, possibly as much as 50% over 12 to 15 months.
So this is a seller's market today, and you're saying we should ride that wave. And in 2016-17, opportunities for buying. So that's the silver lining.
So you've raised your money, that's the time to be investing and finding some fantastic opportunities, and your performance will look great on a 5 to 10 year view if you're able to pick up assets cheaply over the next 1 to 2 years.
Excellent.
Now within those particular risks, Eurozone breakup is obviously the most obvious today. People are focusing on Greece, whether that's this month or 6 months' time, whether that extends to other countries. It's a fragility for the world economy. The US making a mistake by hiking rates. It happened in 1937. Well, they tightened policy. There was fiscal tightening as well. Everyone assumed that was manageable. In fact, it proved not to be. We're in a similar situation now where you think, of course, the Fed can raise 25 basis points. What difference would it make? But it carries a risk. And then you've got China. I think it's always worth worrying about China. It's not our base case that China is going to be a big problem before the 2020s. But it always sits there. And then there's emerging market borrowing. Emerging market governments are not, I think, the cause of the problems, or potential problems. Sovereigns have not greatly increased their borrowing in the last 10 years. It's been banks and other financial institutions which have hugely increased their borrowing in 10 years and might struggle at a time of market stress, and might, if not cause the crisis, be an additional factor making a crisis more pronounced when it happens. That would be the weakness I'd address on the EM side.
So what have the results been in terms of the due to emerging market borrowing in 2008, 2007?
2007 and 8, the biggest risks, the biggest difficulties, I think, came from the private sector debt side at that time. It was more the banking side that had borrowed money externally. Loan to deposit ratios had gone to 130%, in Ukraine's case 190%, and all of the countries that had borrowed so much as that and had borrowed and funded themselves from wholesale markets or international markets ended up going to the IMF, or in Russia's case massively selling down reserves, or in Kazakhstan's case defaulting. So bank crises was the main story in that period. This time I think it'll be a Eurobond issue, which is going to be more problematic next time round.
And then you mentioned the last one was global pandemics. So I think that's...
And terrorism and military conflict. It's all the kind of the black swan events that you just never know when bird flu or MERS is suddenly going to become a problem. So the problem in Saudi Arabia recently has been now spread to South Korea and caused panic and hit Chinese tourism going to South Korea just in the last month. That's unexpected. It wasn't kind of in people's planning, and when we saw SARS back in 2003, we had a similar kind of hit during the tech slowdown. We also had this additional hit of SARS. So that's always out there as a black swan event, which can add.
So what's causing the fragility amongst all the people?
I think the fragility is coming from the fact that we're at the end of the cycle. I think when you're in the beginning of a bull run, 2010, 11, 12, you can even have the Arab Spring, which caused so much volatility. US downgrades followed, the Eurozone went into recession at about the same time, and yet global markets kept on rising. That was the bull run. That's when I can stand up and be bullish despite risks out there. What I get concerned about is at the end of a business cycle, these risks, like housing in the US, suddenly a few house prices start to fall in Nevada and we have a global financial crisis a year later. It's that kind of spin over at the end of the cycle.
So you're saying your list would have been different a year and a half ago?
I wouldn't have been as worried a year and a half ago. There would have been issues, but I think during the cycle, the middle of the upswing, they tend not to derail it.
Charlie, let's talk about Iran and the deal right now that's being cemented with the US. Sure. All right? What do you think is going to be the outlook? When is it going to happen? And what effects will it have, be it positive or negative, on the oil price and on the markets in general?
The story with Iran actually comes back to your first question about geopolitics and whether you use military force, as was done in Iraq in 2003, to deal with the axis of evil country, as Bush called it, or which is, I think most people would agree, has been a bit of a disaster, or whether you use economic means.
Exactly.
And the economic means on Iran, and there's a lot of talk about the financial sanctions, and they do matter. They stop us investing now. However, in 2012, you also saw oil exports cut by 40%, and total exports fell by 30%. GDP shrank by 6% in Iran because of these sanctions on the oil sector. And the consequence of that has been a change of government in Iran. Yes. Rouhani winning the elections in 2013 and coming in and saying he wants a deal. Iran has now come to the negotiating table. And as long as the West gives the sanctions relief that Iran is looking for, this is a phenomenal opportunity. You've got 80 million people, very well educated. One of the largest, it is in fact after Saudi Arabia, which has just opened up, it's the largest country with a stock market of $100 billion.
Very deep, yeah.
I was there last year, wrote a research report. I honestly think it's one of the best opportunities for the next 5-10 years.
Brilliant.
Assuming a deal is done, of course, on the sanctions.
We assume that, we hope for it. So I think the next 5 to 10 years have a lot of moving parts that hopefully will, cement and crystallize to, make it a better place, especially the Middle East and emerging markets, right?
There's going to be great opportunities.
Thank you so much, Charlie. Thank you very, very much.
Nice to see you.